Okay, welcome back, Pete, to another episode of Two Sides of the Table.
Well, it's fantastic to be back in the studio after a couple of crazy busy weeks. And last week we had the opportunity to spend some time together in Brisbane.
We did. It was nice to be in our home state or our hometown for a little while for another week of Evolve. So our quarterly sort of, catch up there. But that's it for the year. We're off travelling for the rest of them. But it was a good week, wasn't it?
Yeah, look, what a cracking way to start the year. And I always love the positive energy and conversations that come out of being in those conferences. But, we've definitely kicked off conference season because we've got Kickstarter, which is the Tech Partner News event in Sydney tomorrow night. And then we've also then got Kaseya Local in Auckland on Thursday. So, yeah, definitely back into airport season, that's for sure.
That's it. And because we are in season 3, we have another wonderful guest. So we are welcoming today Bryn Hardwood from Carbon Corporate Restructures. Restructures.
Yes.
Thank you. So, Bryn, I suppose, tell us a bit about yourself and what you do.
Yeah, thanks for that, Kayla. So I work for Carbon Corporate Restructuring. A big, strong background in accounting, financial accounting and tax accounting, things like that. But I did move into the tech world a little bit as well, leveraging kind of Pete's knowledge over here on that side of things.
Yeah.
So I have, strong background in accounting. And I had a very high mix of construction clients in my previous company. And so unfortunately with construction, there's a lot of pre-insolvency. There's a lot of insolvency, as everyone's aware, that's watching what's going on in the news, what's in the papers and all that kind of stuff. So I actually started doing so much pre-insolvency that I'd formed in Carbon Corporate Restructuring. And I'm helping clients across all fields and all journeys of their business and personal lives in getting good outcomes when they're facing, a potential event that might be coming up.
Yeah, awesome.
Yeah, look, I think, whenever I traditionally thought about accountants, I sort of thought about those people wearing brown pants. They're pretty boring doing your BAS statements. But I think you come from a very unique background, Bryn, is not only are you a business owner, you've been able to successfully exit that business, but you've also then started to see a lot of exposure and a lot of challenges that technology businesses have had along the way. And I think you also bring your own personal experience from, having invested and created your own IP as well, that I think is going to be really unique as we start to unpack, some of the challenges that many businesses are facing in the technology sector.
Yeah, no, I mean, that's right. I probably undervalued how hard it was to build software when I first started getting into that game. And then I really did have a better understanding of what it takes to build software and what IP looks like, and also like the whole monthly recurring revenue kind of stream, some of my journey in that space. And I developed some partnerships with some big US companies and kind of understanding, what the MRR means, what the costs are behind that, and what it takes to kind of scale that up. And it's definitely not an easy journey. So, I take my hats off to the businesses that are doing it well. It is a hard journey to get it right, and it does suck cash flow.
Yeah.
That's the reality of that kind of business.
Yeah. And so, Pete, for the audience's sake, when we were planning out season 3, and you were very adamant that you wanted Bryn on the show to talk about this topic.
Yep.
What value do you think this has got to our audience?
Yeah, and I always think that as a business owner, you always want to have a great group of advisors that are sitting in your corner. The reality is that the reason you're in business is you do one thing incredibly well, and that's typically, you're a great specialist around managed service provider services that you deliver out to your customers, or maybe you've got an SI and you're really strong at dynamics or data engineering, and, that's your strengths. But as a business owner, you often need to have a number of other arrows in your quiver, whether that's legal support, whether that's accounting support, financial planning. And so that's why I think, one of the things that we don't often think about is who do you turn to when things aren't going as well as you want them to? And it's really lonely at the top when, you're looking at the profit and loss statement, it's not going in the right direction, there's more red than there's black. And that's why I think Bryn brings a really unique perspective to the table to help business owners go, well, who do I turn to when things aren't going well? And I think if we look across the IT sector, especially IT services, it's not an uncommon fact that 6% is the average EBITDA that most technology businesses have. But unfortunately, 25% of businesses today aren't making a profit.
Yeah.
And there's only so long that you can operate like that without needing external help, which is why I think your conversation with us today, Bryn, is going to be really insightful for people to understand there are options and there's people out there that can help them through.
Yeah, no, 100%. And like in some of the transactions I've been involved with, it's getting the person like me, the consultant in the room, the lawyer in the room, the accountant in the room, and understanding what all those people are kind of doing to help the board or to help the directors look at these outcomes and look at the options they have to get through these outcomes. And so sometimes we call it the dream team, like getting the right people in the right place and then having them all work for you is what's important if you're looking at some type of event or something's happening in your business.
Yeah. And look, I think maybe it's worth us taking a little bit of a step back because, look, we all have cash flow challenges. Every business goes through them and, it's those ebbs and flows. But unfortunately, the reality is a lot of creditors are getting a lot more aggressive at the moment. And I think there's many technology businesses that have lent on the ATO, especially coming out of that COVID period where there was a lot of leniency from the ATO about paying, your BAS on time, your PAYG on time. They're not quite as lenient at the moment. And you see that across the board. Is that something that you're seeing, is that creditors have changed?
Oh, yeah, 100%. I mean, as you said, like ATO had been for some businesses, the second bank almost, where they knew that they could, have debt with the ATO and put it on a payment plan or just let it slide. And it was an easy option. I think the ATO now, if you look at the DPN numbers, like director penalty notices that have been coming out, they have exponentially ramped up, post this COVID period. So the amount of DPNs coming out of the ATO now is, back before COVID, that's probably where it was closer to. So yeah, in our accounting practice, we see that more and more. Lots of DPNs, and directors really don't know how to deal with the DPN. So yeah, I definitely see what you're seeing, 100%. And also, I guess in terms of other creditors, there are a lot of kind of fintechs and places like that out there. And, they can be really fast to move if you start to default on payments.
Yeah.
So I find that a lot of people get into trouble. They can't pay their ATO, go to a fintech provider, sign off there. Then when that misses, that's when you're looking more at a receiver coming in. So potentially when they couldn't make the ATO payment plans, that's when they should have been looking at their options.
Wow, and it sounds like it goes from zero to bad potentially very quickly for people.
Like it can go extremely quick.
Wow.
And you've got to realise, like, when you're signing things off, do you have personal guarantees on what you're signing off? If you skip a payment on this, what's the outcome of that? So you really need to understand what you're doing. And there's always an analogy I had that a mentor told me, and it was kind of like you get a bucket, and it's got a bunch of holes in it. And the first thing that a lot of directors do is go, when the bucket's empty, we just need to pour more water in there to keep it going. And that's kind of the worst trap, because they should be looking at the business to understand what you were talking about before, Pete. What are their margins? Are there profitable elements in the business? Are there parts in the business that are bringing the business down? Are there things that need to be restructured in that business? Is it too top heavy with employees? Are the operational expenses too high? These are the things they should be looking at before pouring water in that bucket that's got holes in it.
So maybe just for my benefit, but can we talk about the differences between like receivership, liquidation? What is the stages? Like, what are the steps?
Yeah, no, 100%. So I guess it's kind of like, what are the triggers that are getting you to, look at these options? And generally it's, I've defaulted on my ATO payment plan, so now I've got a director penalty notice on me, and that's only giving me 21 days to action. So now you have to action off that. Now, when you do that, you generally have a few different options that you can do. So you can appoint an administrator to do a small business restructure potentially if you meet the criteria of the small business restructure. So I won't go through all the criteria today because we can put that up on a website or whatever. But there's criteria around the small business restructure. Now, with the small business restructure, if you meet the criteria, an administrator can, deliver a pack to the creditors, and that could be a pack on your debt in terms of what the cents in the dollar is that you're able to pay. So, for example, you might have a look at it all and the criteria are all mixed. So you tick those boxes and then you go, yes, we're going to do small business restructure. The administrator will help you do this pack up. You'll send that off to the creditors and the creditors vote on it. And so if you throw up, let's say 45 cents in the dollar, creditors vote on it, you can write off 55% of your debt in the small business restructure. So that's one option you have. Now, there are a lot of options you have. So you could do, and really, before I go, I guess, to these next options, it is analysing that business to work out what the directors want to achieve. If they've got a board, like what outcomes do they want to get? Sometimes if we go back to the bucket and there's no way we can plug those holes, like if we just say this business isn't viable.
So the restructure plugs the holes, so to speak?
Well, that is a business, is the bucket in my terms, right? And those holes are your margins aren't good enough.
Yeah.
There's too many operational expenses, too many employees.
Yeah.
Whatever that
Gotcha.
case may be, we
Yeah.
need to analyse that. And we might analyse it and then say, based on this is what the business looks like. It's just not viable, right?
Yeah, wow. And look, I think one of the challenges is, I remember when I started a business and, all of a sudden I thought, I'm now a director, I'd put it on my email signature, when I
not that
first
glamorous.
started. But I really probably didn't understand the risk that's associated with being a director and the fiduciary duty that I had with that. And I think one of the things is, I remember early days, cash flow is really challenging, and you start to play that sort of juggling game is, I'll pay this vendor because they're, making lots of noise, or, my PSA vendor, I need that to be able to continue to deliver services to my customer, or my RMM vendor, and then I'll then kick the can down the road with another one. And, you almost feel like some nights you're lying in bed staring at the ceiling going, what do I do? And I think, often that what do I do is where a restructuring organisation can really start to lay all the options out on the table there, because I think one of the things is it is a complicated landscape. But one of the things always, I think, as directors is, at the end of the day, you've got a family and yourself as an individual to be able to then protect. And my understanding is that's exactly what your business does, is helps organisations be able to separate that risk component.
Yeah, no, 100%. That's exactly it. It's kind of like working the business out and seeing what the options are with the business, working your personal side out and seeing what the options are over there, and then coming up with a strategy that's going to align all those. And I mean, like when you're mentioning those suppliers, we really want to look at the suppliers and find out, as you said, I need this supplier. So that's a critical supplier. So we've got to make sure we keep that supplier on board, we communicate with that supplier, and we let them know exactly what's happening. Because, take out restructures and administrators and things like that. If you don't have those critical suppliers on board, your business might not be able to continue,
Yeah.
right? So there's a big communication piece around that. And what a lot of directors do, if I just go to Pete's analogy, is they get into that scenario and they don't quite know who to pay. And so they kind of put their head in the sand and they don't communicate with their suppliers because they don't have the money to pay them, right? And that is probably the biggest mistake that I see.
There's probably a bit of embarrassment that goes around that as well,
Oh,
right?
big time.
Yeah, like having been through it on the early days of business, you almost think of yourself as a failure.
Yeah.
And you think you're very alone. You're the only one that's in that situation, and you try to sort of dodge and weave, and you end up blocking calls and the email. Oh, I didn't get the email.
Yeah.
All those sort of things that happen. And so, when should someone look for some external help?
Yeah, I mean, look, my advice is always earlier rather than later, right? So, I mean, some trigger points could be, if you can't pay those critical suppliers and you're going on a payment plan with them, and everybody in business probably does that occasionally, right? Like you just have a bad cash, like December's just been here, January's been here, cash flow's tight.
Yeah.
Like that's different than every month you're struggling to pay your critical suppliers and or you can't pay ATO or you can't pay, bank loans or whatever the case may be. As soon as you start defaulting regularly, you should be looking at a plan, because the first option might not necessarily be let's refinance. It might be, let's actually fix the business first. And you might be able to do that out of organic cash flow. So it might be that you just need to get some advisors on board that can manage the margins. And instead of having, I guess I'd describe it as a tax accountant, like instead of having your accountant that does your tax returns, you might actually need to bring a specialist team in where we can look at it and have a more CFO service that will analyze all of these numbers and give you a go-to plan. Then if that go-to plan doesn't work, then start looking at, okay, what are the other options here? Now, that go-to plan might include refinancing because it might be required, but fixing the margins first is generally the most important thing to do.
Yeah.
Okay. And so one of the things you often hear about when you hear the word fiduciary duty is around solvency. For our listeners, what does that mean? Because my understanding is there's a difference between cash flow challenges and solvency.
Yeah, 100%. And solvency is actually really hard to work out. So somebody could say you've got an insolvent business, but it's not that provable to say that business is insolvent. The reason I say that is because solvency is being able to meet your debts as and when they fall due. But you could have funds on the outside of the business that you can bring into the business to pay those debts.
Yeah.
So it's very hard to say the snapshot of when that business exactly was insolvent. But I mean, if you're seeing the triggers that we were talking about before and you're not taking action and, you're continuing to pile up debts in that business, it gets to a point where you're trading it insolvent. And a director has a fiduciary duty if the business is insolvent to appoint an administrator. So if they don't appoint an administrator, any debts from that point they could be personally liable for.
Wow.
Yeah. So this is a point that a lot of business owners don't realise, and so if they continue to trade for 6 months, any debts they've accumulated in that 6-month period, they could be charged for personally. And if they've got a family house or something like that, then potentially that's at risk now from the business.
Yeah, and look, it's really amazes me, the insight there. And look, this is not something that people teach you.
No.
You can go to ASIC and start your business, register for an ABN, but no one tells you about all of these rules and regulations. And you almost got to actually graze your knees along the way with that. Because I think the reality is you go into business typically as an optimist. There's a little bit of that entrepreneurial spirit in everyone that started a business. And I think most people always think, well, there's going to be a sale next month, or I'm going to be able to sell my way out of this, or I'm going to get some more customer revenue directly coming in that's going to allow me to get out of this situation. And I think it's that old analogy is that, revenue is vanity and then cash is king. Cash is, for me, it sounds like, is one of the big things that people need to really think about managing effectively to avoid these situations.
I mean, especially in software, because, the margins can be quite thin at times. So, if you're not managing your cash flow and there's large CapEx and, you're paying some of these bigger companies, cash flow can really get damaged. And I think the whole sell your way out of it, if you're not selling stuff at a good margin, are you digging yourself deeper into a hole? That's the challenge, isn't it?
Yeah, and I think, it's easy to think about, let's go and sell some more hardware at, 18 to 20 points margin, or maybe go and sell some more M365 licenses at sort of, 14 to 15% margin. But it's not a lot at the end of the day. And so really it comes back to, once again, is understanding the patterns inside of your business and what are those high value margin items such as recurring revenue, then professional services, then the transactional hardware and licensing pieces there. But let's say we've got some listeners out there that have got some cash flow challenges. As you said, we're in February. Often it's quiet during sort of that December, January period. What do you think some tips are for people around how to managing that because often the problems are caused upstream.
Yeah, that's
someone
right.
else is not paying them, and then that
Yeah.
has a flow-on effect.
Yeah.
What are some of the things that business owners should be thinking about, managing that cash effectively to help try and avoid some of those challenging situations?
Yeah, 100%. I think like when you were talking about the cash, it's that cash flow conversion cycle, isn't it? Like, if you're selling hardware, for example, do you get money up front from the client, or, what does that cash flow conversion cycle look like? Because if you're paying for the hardware here and then they're paying you 30 days or 60 days down the track, the cash flow conversion cycle on that's not very good, because although there's 20 basis points on the hardware, you're not getting that until 30 days or 45 days at times. So understanding if you can charge the clients up front for certain percentages and then on the back end for some things, but understanding what that cash flow conversion cycle looks like in the business. And then obviously, managing things like your debtor book, effectively being able to pull those debtors in. If people are on monthly recurring revenue, then I guess it changes, because that does fix the cash flow cycle in a lot of instances, because they're paying on this monthly subscription model. But then what are the costs behind that? And I think with professional services, one of the keys is asset utilization. Like that's what in accounting we term it as. And it's like, do you have the right people doing the right things at the right times?
Yeah.
So if you've got an engineer in your business, but he's doing level 1 support work, your margins on that monthly recurring revenue are probably not too good if you actually are measuring the costs against the monthly recurring revenue.
That's a great point.
Yeah, so I mean, these are some of the things we can do when we analyse the business to try and find out what areas are profitable, what areas are not profitable, and what you might find is you got a great monthly recurring revenue of 100K a month, but the costs against it are 95. So
I always remember back in the Wardy days, look, our vision was always to be able to actually have enough recurring revenue on the first day of the month to basically pay all the bills. The challenge was we kept growing the business, so those bills just kept increasing, so it became harder and harder.
Yeah.
But one of the tools I know that you've used, as well as I've seen a number of other people use effectively, is a tool called Cash Flow Story. And so you've spoken a lot of accounting terms, and for me, I'm a simple guy. I just like to know, okay, what are actually my key metrics? What does that actually mean for profitability? But also how much cash I've got sitting in the bank. I'm pretty simple. And so what I found with Cash Flow Story is it allowed you just to take a couple of those inputs to understand, well, if I increased my revenue by 1%, so increased prices by 1%, what does the impact of that have on me? But also one of the ones I was really amazed with was understanding if I could reduce my aged debtors by 1 day, in other words, maybe people pay me on average by 24 days, if I could reduce that to 23 days, how much more free cash that created for me directly with that. And the learning that also allowed me to do early on in business is, now, as business owners, we're often paying our team members either weekly or we're paying them fortnightly. And, the labour costs are always the biggest component in a services-based business. So by flattening that out and moving that to monthly and later in the month, allowed me to then smooth that cash flow. Because there were those months where all of a sudden I've got 5 pays rather than 4 pays, and I've got to find the extra money for that. But also for me, it was, well, if I send out all my invoices on the first of the month and I don't need to then go and pay my team until later in the month, I've got enough time to go and collect that. Are they some of the challenges that you're seeing is when you talk about that free cash flow, is that alignment and being able to use that working capital effectively?
Yeah, no, 100%. I mean, it's, I guess, bringing that cash in as soon as you can and delaying payables out as long as you can is the best outcome for the cash conversion cycle. You could have a fairly profitable business that could go broke just on the cash flow conversion cycle. So you see that a lot in construction, where it could be a profitable business, but they're not getting paid until 45 days or 60 days, and that doesn't pay your wages. So although it's on the profit and loss and it shows it's profitable, there's not cash in the bank to pay those salaries or contractors or however that looks. So definitely understanding that, and I think what you're talking about before is really that power of 1%. If you bring the, DSO or AR, accounts receivable days, if you bring that down from 30 to 25, how massive an impact that actually makes on the business. Or if you can push accounts payable out And smoothing, like you said before, with, doing monthly and aligning that with where the income is. I think these are all some of the secrets, and there's probably not like one perfect thing to do. It's probably like kind of trying to do all these things across the business, if that makes sense.
And these are the types of things that you look at in a business when you go in there to analyse it.
Yeah, well, 100%. So generally I'm coming in and I'm looking at like what the options are with the business. Can we cash flow our way out of this? And then, if we are going to cash flow out of it, what are the changes we can make in the business? So talking to the directors and people involved with the business on how do we get this profitable enough? And once I work that out, I can look at all the repayments, so from ATO and all the creditors. And if we put that together, can the business cash flow this per month? And if it can't, then we're looking at other options. Is there a way we can reduce the debt? So we talked about the SBR briefly before. And then some other ways we can look at debt is to, go into a voluntary administration. So a voluntary administration can be quite scary for business owners because they say, I'm not going to appoint an administrator. This isn't the end, blah, 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 blah. But I, often say that, once you appoint a voluntary or an administrator to do a VA, then you have more options while it's in voluntary administration. So some of those could be throwing up a deed of company arrangement or a DOCA. And that works similar to the SBO in terms of the fact that you can go to the creditors and say, here is a pack, and you show them this information that we're putting them together, and then they might be able to get a sense in the dollar on their debt. A lot of the times, a lot of people think that the critical suppliers are not going to support them, but a lot of the times they might take, let's say, a haircut on some of what they're owed if they know the business is going to be able to perpetually run and they've still got that as a client moving forward. So
so it sounds like what you're talking about is worst case scenario. We've sort of woken up. Often that's caused, my understanding is that there's been someone that's knocked on the door chasing that debt quite hard.
Yep.
And maybe it's someone that's sent a statutory demand.
Yep.
So, a statutory demand's a legal instrument that then says that someone has to pay within a period of time.
Yep.
And if they don't pay in that period of time, the business is considered to be insolvent at that point in time. And then there's a wind-up. Is that the correct interpretation of what a statutory demand is?
Yeah, no, that's correct. I mean, once your creditors start sending your stat demands, or you're getting director penalty notices from the ATO, you're really starting to put a time limit on what we discussed before. Am I trading insolvent? Well, now I'm getting creditors sending me stat demands, or I got a DPN. I'm forced to take one of these actions that I'm talking about. Or you start to look at really taking a lot of risk personally as a director. So that's generally when people will come to me. We'll go through these options. And there are more options, like involuntary administration, deed of company arrangement is one. We could sell the business. There could be parts of the business that are profitable that we could buy back from the administrator. Because once we do the voluntary administration, the administrator takes the risk from that point. So it stops all the risk that you have personally. So it brings that to a head. And the stat demand is probably going to bring that faster. A director penalty notice is definitely going to bring that faster. Better to do it up here than to get right to down here. Because generally, what I mean by that is by the time you're getting those, you probably would have known 3 months before that you were starting to struggle to pay suppliers. And that's the period that you're better talking to somebody like me to, go through these options.
So Bryn, obviously no business ever wants to get into that situation. And I think it's like most things in life is the more that you communicate, the more you can manage the scenario. I've always had a saying for my engineers that I've worked with in many businesses, no one gets in trouble for over-communicating. So over-communicate to the customers, and it sounds like the same thing over-communicating with your suppliers. But as we said before, that's often hard. Can someone like your organisation come in and help manage those conversations? And early on, if you're not wanting to have those hard conversations to help manage a payment arrangement or renegotiate, is that where you might be able to come in?
Yeah, no, definitely. I've worked with a lot of directors and a lot of companies where we've helped them, on how that communication's going to look with their suppliers and, what to do, especially critical suppliers. because without them, without their support, the business is it's gonna find it hard to run regardless. You spoke about a critical supplier before, where you knew they were your critical supplier. And yeah, we can most definitely help in that aspect. And also, if we get to one of these options, to demonstrate that the business does have the ability to trade out of this and get through it.
Yep.
And so that's really important, because generally you're going to rely on their support because they're a creditor. And if you are in some type of DOCA arrangement, they're going to have to vote on that. So we need them to vote on it to say, yeah, this is a viable business moving forward. We can see the changes and we want to get behind them. And then that could be a client for another 10 years. Yeah. So although you might take some type of haircut on the debt at some point, what's a 10-year client worth?
Can they, say you have a blip and, you have an issue where you need to do that administrative process and, you're asking your suppliers to take a haircut on what you owe them. And say you trade that business out of that issue and it's, highly profitable, highly successful business, you stay with that supplier. Can they then recall the remaining percentage that they took the haircut on later?
No, but it could get pretty complex to answer the question. But once you actually bring that to a head and you get an agreement with your suppliers, that's then done. So anything pre-appointment you've dealt with, and they can't come back because they agree on it. Yeah, they sign off on it to say, we're happy with that. Yeah. But, I mean, you could put up a scenario where they get 100 cents in the dollar out of the deal to say they need to get paid in this. I mean, especially sometimes contractors that are critical, you can do that in the deal to say these guys are going to get 100% because they need 100 cents in the dollar. So, yeah, there are options there. As I said, you can sell the business as well. Once you appoint an administrator, really, we can then go out and say, what are the options? If there's a profitable part in the business, you might be able to sell that and that will get creditors back money as well. So, yeah, there are a lot of, what did you call it before? Arrows.
Yeah, arrows in the quiver.
Arrows in the quiver. There are a lot of arrows in the quiver. Yeah. There are a lot of things we can do. The problem you have is if you don't do anything and you write it out, and what we see a lot, and it's amazing, is people will get a DPN, which is a director penalty notice, and they don't action it at all. And then they come to us and they're like, we have this DPN, it's 6 months expired. And, if you do things like that, like if you just ride the business out too far, most of that debt's now going to be on you personally. And now you're looking at, I'm going to have to sell my house or... the conversation gets a lot darker.
Yeah.
And I think the reality is we live in a connected world where, back in the old days, one information system would not talk to another information system. So, credit reports have a lot more information and a lot of people are reporting on those things in a lot more timely manner. And sometimes, in the past, people might have been able to kick those cans down the road. Yeah. But now they're finding when they're trying to, maybe refinance the home loan or do something like that, all of a sudden there's this blemish that then turns up that they just haven't dealt with the problem at the time.
Yeah, that's right. I mean, you know a lot more about data than me, but, all these government organisations, financial institutions, the data's all there and it flows really, really fast. So, especially like with insurance companies, for example, or debtor insurance, things like that. As soon as an event happens, they send it out to everybody. So everybody knows. Yeah. Nowadays also the ATO... can actually put you on the creditor list if you've missed ATO payments. So they have that as one of their tools. Like they have director penalty notices. They have garnishes where they can actually just come in and garnish your bank account if you've defaulted on payment plans. And they can report you to the credit agencies. So what that means is like all your suppliers will know that you've got ATO debt outstanding. So they have a lot of tools that they can use, and they are actively using all of those right now.
Yeah, wow.
Yeah, and I think, the businesses often go through different change. And we've spoken on the podcast before about how many businesses started as break-fix businesses and then went into the recurring services and then cloud and now AI. And often there is almost this boat anchor that exists inside of the business, as you described before. And I saw it actually firsthand with one of our customers back in the Wardy days. Is they had a number of retail stores across a number of shopping centres, and they used administration as a tool in order to be able to get out of leases that were no longer effective for them.
Wow.
And so I always think that when businesses have challenges, it's about bringing experts in that have got the right advice and the right structure that allows them to operate. And there was nothing wrong with this business. They've successfully grown and flourished for many, many years beyond that. but it's then just having someone else that allows you to look through a different lens. Because I know as a business owner, when I'm under stress, my judgment gets clouded. I can't see the wood from the trees. But someone like your services, Bryn, can really be valuable to bring in and just then, explore what options there are. And sometimes there might be some real simple tweaks that, you just can't see, negotiating with supplier for longer payment terms, for example, or renegotiating with your existing customers to pay you more timely, all of these things that you can then assist with.
No, 100%. Actually, we dealt with NDIS business that was similar where they had lots of leases, but there was a really profitable part in the business. And when we put it into administration, we were able to cancel those leases, as you're saying, and then just get back to the core part of the business that was extremely profitable, kind of like downsizing the business and then doing a deal on the debt that they had. And I think in that deal, we got the creditors back 45 cents in the dollar, which is a pretty good outcome on both sides, which is important. So, and in that, it was being able to actually legally get rid of those leases once it was in there and using the administrator and reducing the risks. Plus, one of the directors had a DPN in that scenario. So we extinguished the DPN, and with the payment plan, it's interest-free over 24 months. So as a lot of business owners know, the ATO's generally circa 11% interest. So it's a big, if it's a big sum of money, that makes a massive difference over 24 months.
Yeah, definitely.
And so, I think the key for our listeners is there are options out there. So, if you are running into any distress, have the conversation, but also then look to bring in someone that's able to then help you understand that, but also start to leave you with the tools so that you're able to effectively run the business afterwards as well. Because I think one of the key things I've seen with organisations like yours, Bryn, is not only do you help then solve the problem, you actually then leave the right tools to help avoid the problem next time around.
I think that's actually a really, really good point because in Carbon, we're a national accounting company. So we have obviously tax, but we have CFO, restructuring. We have a lot of allied services. And what we've been doing a lot with working with the administrators and then post-DOCA or post-SBR or post whatever the event is, as I said with the bucket analogy, what are we going to do to really plug those holes? And if you've just got a tax accountant that does your tax returns once a year and you don't have the internal capabilities to be able to do cash flow forecasts or, projections or any of these other types of things, the CFO service that we offer, we can really actually come in and start doing, those month-end reports, board reports if necessary, cash flows off those, and that puts the business in a lot better position. And sometimes it works out cheaper than your internal finance.
Yeah.
So it's actually like that fractional CFO or in your game, maybe fractional CTO. It's kind of equivalent kind of service. Yeah, like I couldn't, for instance, maybe afford $180K a year for an engineer, but using a fractional engineer, I'd probably get the right amount of service at the right price.
Yeah, so it's almost like a VCIO or a VCISO, but specifically for your books and all of your accounts.
Yeah, no, that's right. Yeah, that's right. And it comes in cheaper than trying to hire a chartered accountant to come in the business, but you're not really quite big enough for that yet. You're not at that level. So you can use the fractional, and then also when you're going to hire, get them to assist with the hire and place that person in the business. So very similar to that. And we do a lot of that work because we get to know the business going in. And then also sometimes those business owners and directors are better to deal with because they want to change.
Yeah.
So some people out there, there's no, what's the word for it? There's nothing to actually force them to change. So, inertia becomes the worst enemy. But when they've been through something like that, they're like, okay, I'm going to do things differently now. I need to focus on my finance. I need to make sure the business is performing here. And generally it's around, 3 or 4 critical numbers in the business. And I think, Warder, you'd probably attest to that. You don't need to know your numbers, but if you know your GP margin on software sales, if you know your GP margin on monthly recurring revenue, if you know these things every month, if you know what your operational overhead expense margin is, they're the main things you need to know. And you know the business is on track at that point.
Yeah, wow. What an insightful conversation. Look, I think, we've covered a lot of 3-letter acronyms, and I thought technology had a lot of 3-letter acronyms, but, VA, DPN, SBR, things like that. If people want to find out more, Bryn, what's the best way for them to get in contact with you?
Yeah, no, definitely. I mean, I can give some details up and get Carbon up there. Reaching out to me via email, through the Carbon emails or through the phone. And I mean, I can have a chat and just see what's going on. And that doesn't cost the business owners or directors any type of investment at that point. And then I can tell them what the next steps are. So, yeah, I am actually apologise for using a lot of those acronyms because I do try and kind of break it down. But unfortunately, when you're in an industry and it's so quick to go to acronyms and that people are like, what does he mean by that?
Yeah, so hopefully we've played the TLA police actually throughout the episode. But I'm sure if people would like to know more, you're on LinkedIn as well, Bryn. I'm sure people will be able to then find you there and reach out. And I think your advice about just having the conversation early and the fact to know that there is, almost that free advice to go, hey, what are the options and explore those. And really for business owners to know they don't have to be alone.
That's it. Yeah, well, right. Bryn, thank you so much for joining us on the podcast today. And Pete, thank you for joining me on the other side of the table.
As always, it's fantastic. And I'm looking forward to the next episode that we've got about how we start to unpack some of those strategic advisors that people can have to be able to get them out of those hard situations like we spoke about today.
Awesome.